Hey guys, thanks so much for tuning in. Today's topic is refinances. So, what kinds of refinances can you do with the VA loan? What are they called? What do they do to your mortgage? All that stuff. We're going to cover all that stuff, and so that way you better understand what you're getting yourself into. So, let's go into why you would do a refinance. So, or what is a refinance? A refinance is essentially you buying your house all over again with a new mortgage, and it's structured differently. And yes, it does restart the loan over from day one, month one, year one of the payment. So one of the things that you have to be aware of is that it will restart your loan. And one of the biggest concerns I have a lot from clients is that, oh, I have to extend I have to reset it in another 30 years, and it'll take me 30 years, even longer to pay off this house. What I will say is that you can also add extra payments to your mortgage payment, especially if your mortgage payment, the new refinance payment, the new refinance mortgage is lower than what you have now. What you could do is take some of that savings and add it to your current mortgage payment, and then you'll probably be back on track pretty fast and pretty easily. One quick little tip here is that one extra mortgage payment per year will actually save you about 3 to 5 years off your loan. So something to consider when you're and make sure you put it toward principal. That's the main thing. But when it comes to refinances, that's essentially what it does. It restarts your loan for a new mortgage. And what it happens is that the old mortgage is paid off and it gets replaced with the refinanced loan. Now, there are two types of refinances that you want to keep an eye on. One is called the VA Cash-Out Refinance, and the other one is called the VA Streamline IRRRL. The IRRRL stands for Interest Rate Reduction Refinancing Loan. So let's talk about the VA cash out refinance. This is the most popular one. So how would this work? Well, how do you cash out? So there's two ways. There's a couple ways where you can take advantage of equity in your home so that it puts you in a better position. One of them is to sell the house. That's one way to get the equity out of your home. The other way is called the cash out refinance. So essentially what a cash out refinance is how this works. Let's assume you have a $100,000 mortgage and your house is now worth 200. Okay. So you have $100,000 left on your loan and your house is now, after let's say 5 years, your house is worth 200K. What you can do is take some equity out, right? It's because now your house is worth more. What you can do is take out a loan up to about 175, 180, right? That's the new mortgage, 175 or 180. And what generally, after some closing costs, the difference between the old loan and the new loan, let's say it's about $60,000, $70,000 left after everything's paid for. That's how much will go into your bank account for the difference. So you'll have $70,000 basically in your bank account when the refinance is through. Now, why would you take out a bigger mortgage knowing that your mortgage payment's probably going to be a bit higher, but you get to cash out this amount? There's one big reason why you would do that: debt consolidation. So there's a very strong chance that the change in the mortgage payment is not going to be as significant as the $70,000 of consumer debt payoff. I can definitely say, $70,000 of extra mortgage, if stayed at the same rate, it might make your payment about $300, $400 more. But if you paid off $70,000 with consumer debts, there's a strong chance it could save you $1,400, netting you $700 a month. So a lot of people will do that to consolidate their debt and put it into a better term mortgage, especially these credit card debts, because some of these credit card debts are in the double digits for their interest rate. And another thing about credit cards is that you're charged interest twice, one in your payment and one on the balance. So it makes it a little bit easier for people to be able to consolidate their debt, save a decent amount on the overall finances, and maybe you can take some of that payment, some of the savings that you're making, and add it to your mortgage payment, the principal, and then you could possibly be back on track, paying down your mortgage a little bit faster and faster along the way. So that's one way to take advantage of a cash out refinance. Now, here's the thing: you don't have to consolidate debt. You could be using it for a future purchase that you need to do. For example, home improvements. You can pay for home improvements because knowing you could take out a $70,000 loan anywhere else outside of a cash out refinance might cost you more than doing a cash out refinance. So that's one way to consider it. Another way you could take advantage of your equity without doing a cash out refinance is taking what's called a second lien or a second loan in a form of what's called a home equity line of credit or an equity loan. You could do it that way. I like lines of credit better because you only pay off based on the balance of what you owe and you just treat it like a credit card. It's a lot better than a normal credit card, but it is a line of credit. It's a lot more flexible, I personally feel, but that's one way to do it. I would say if the purpose of your cash out refinance needs to make sense. So if you're trying to like consolidate debt, cash out refinance makes the most sense, depending on how rates are looking. Now, sometimes I've had clients where they did a cash out refinance, consolidated all this debt, and if we compared the mortgage payment was still lower. So that's an environment when rates are lower than what they had then, and they did a cash out refinance, so they save even more with rates being lower. I've had clients who had to refinance for a rate that's almost double than what they have, but they still saved about $2,000 a month on their mortgage, on their overall finances, because they paid off so much debt. So it's not out of the question that getting a higher mortgage rate could help, depending on how much debt you're in. I'd say a cash out refinance makes sense if you're over at least $50,000 to $70,000 in consumer debt. When I say consumer debt, I'm talking about personal loans, auto loans, credit cards, other types of loans, signature loans, solar panels, stuff like that. So if those payments are adding up, and if $70,000 of debt is costing you about $1,000 a month, it actually would make sense to refinance, even if the rate's a little bit higher. So that's something that we help run those numbers through for our clients. So I just want to give you an example of what that looks like in a worksheet that we created to help you understand what those numbers look like. So here you have on the screen is this client looking to consolidate a decent amount of debt, right? Based on the equity they have in their house, we run some numbers. We kind of figure out how much equity they can use to pay off debt. In this case, we're paying off about $113,000 of debt, and that $113,000 of debt is costing about $2,600 a month, a little over that. So we consolidated all their debt into this mortgage. Their overall finances will save them about $1,600, which is a pretty significant amount. So the way we did this is that we set it up such that they will go 2 months without a mortgage payment. So they're going to save $2,600 and 2 months of the current mortgage payment, which is about, if we're comparing it, $2,600. So they're paying about almost $1,700. So $3,400 over the course of 2 months, and then about $5,200 in consumer debt payments over 2 months. So they're probably saving about $8,000 to $9,000 over the course of 2 months. And then if we look at their new payment, yes, their mortgage payment is going to be higher. But if you look at their overall finances, it actually improved by $1,600. So now they have more cash flow for their housing, for their family, and they can take that extra $1,600 and probably knock out these debts pretty quickly. If they really dialed everything in, they probably within the next 18 months, they took that $1,600 and they paid off that debt. They'd be debt free in about 18 months. So and imagine all this other debt that they have. So, and they also, I think they wanted some cash out, so we were able to get them another $7,000. So that's an example of how a cash out refinance could really put you in a better financial position, even with the rate potentially being higher. I think in this scenario, they were going from 3.75 to 6.5%, and they're still saving about $1,600 a month. So that's the power of the cash out refinance, with your rate even almost doubling, sometimes tripling. So that's an example of the debt consolidation for the cash out refinance. Again, with the cash out refinance, you don't necessarily have to pay off debt, but I'd say if you don't have any debt to pay off with when you're doing a cash out refinance, it's probably better for you to do what's called a HELOC or a second loan on the property, because then you only pay for what you owe and you're not changing the finances of your current mortgage. Now, the other thing we want to go into is what's it look like for a refinance just to get a better rate. So with VA, there's a really cool option called the VA Interest Rate Reduction Refinance Loan, which is called the VA Streamline IRRRL, is how we communicate it. And what's great about this type of refinance is that the documents required from you is a lot lower than a cash out refinance. A cash out refinance requires just as many documents as a purchase. But with a VA Streamline IRRRL, all we care about is making sure your loan, your mortgage is currently up to date. So you don't have any late payments on it. And we just look at the recent mortgage statement. We really don't ask a lot of information about you like we do for a purchase or a cash out refinance. Now, what's cool about the refinance loan is that it does have a couple of rules that we have to follow. With the VA Streamline IRRRL, the couple rules that we have to follow is that the new rate must be a 0.5% better than what you have now. The next rule is that the verbatim rule is six mortgage payments and 210 days from the first mortgage payment, which I always just say, once you made the seventh mortgage payment, then we can start the refinance process. Most times, depending on how rates move, I usually reach out to my clients at the sixth mortgage payment to see how things are going. And then the last major one is a 36-month recoupment. So with every refinance you do, whether cash out or VA Streamline IRRRL, there is closing costs involved. How this is typically structured is that it gets rolled into the loan. This closing cost isn't very much. Usually it's about $7,000, maybe $8,000, maybe $9,000, $10,000, something like that. So what that means, why that's important to know, is that the cost to do the refinance, the closing cost with points, must meet a 36-month recoupment. Meaning, however you structure the loan, the closing costs and points, if there are any, based on the new savings, must be recouped within 36 months. For example, if you are saving about $400 a month, right, then the most your closing costs and all the rates and the rate buy downs and stuff like that must be less than about, if we're doing $400 a month times 36, we're looking about almost $14,000. Okay, so all the closing costs and the points must be less than $14,000, roughly. Probably closer to 15, maybe $15,000. So that's what it's talking about, is that all that cost must be recouped with 36 months based on how much you're saving on the payment. Now, what's cool about the VA Streamline IRRRL, again, the amount of documents is extremely low. It's very easy to do, very simple. As far as the timeline goes, how I normally structure all my refinances is that we can try to close, our goal is to try to close beginning of the month. That way you have the ability to skip, basically don't have a mortgage payment for 2 months, and then your next mortgage payment is lower than what you have now, or at least your finances are better than what you have now. And it's I can't really talk much more about that, but it's really that simple of a loan. It's really not much more than that, but I wanted to give you an example of how these numbers can change. It does still replace your current loan. We can adjust it based on, let's say you already 3 years in your current mortgage. We could do a 27-year VA loan IRRRL on that. Again, I just say, just take the 30-year, get the lower payment, and make use of the savings, and whenever you have no use of it for anymore, put it toward the principal and you'll be back on track very easily. So what I want to show you guys here is this client who is pursuing the VA Streamline IRRRL, and based on how much, and also shows how much they're saving. So we can obviously, their current payment here is about $51.50, and their new mortgage payment, based on a couple scenarios that we ran, the payment could be from $450, or the savings could be between $450 to $600 a month. So one of the things I want to point out is what you're actually saving when a mortgage rate is lower. So yes, you do have that upfront savings of say $450, $600. Again, this is all based on a $700,000 loan. So these basically $700,000 with all the closing costs and all the points rolled into the loan. So what we're looking at here is about a $700,000 loan, how much it would save based on going down to a rate of 6% or 5.5, because their current rate right now is at 7.125. So basically more than a percent change on their rate, which is a pretty decent amount. So the 450, and this scenario, why it's different is because this is a rate at the 1 point buy down. With all the closing costs involved, and the option 2 is with 2 points buy down with all the closing costs involved. So in this scenario, she's either saving $606 or $450. Okay. Now, what I want to show you guys is what changes within the payment when you adjust the rate. So if your rate is lower, obviously you have the lower payment, but what actually changes? One of the cool things you will automatically notice is that the purple between the current payment and the other two loans is significantly smaller. So that's one of the biggest savings with a lower rate is that the true cost of a loan is interest. That's what it is. The principal portion just goes back to you in the form of equity. I think of the principal portion of your payment as a forced savings account. That's essentially what it is. Now, if you notice in this scenario, the interest is almost 35.50, basically 35.50, and the interest in this one is $3,000 or $2,800. So really, it's almost like a $500 to $800 change in the interest portion alone. Now, the other cool thing is that the principal portion is higher as well. So you're saving on interest and you're increasing how much you're paying on the principal. But the overall payment is lower. So in this case, it's almost like a $60 change in the principal, which is, again, I agree that's not very much. And from here to here is another 70, 60 bucks. So yes, it's a very small difference, but if you think about it, if you add a $500 to $800 change in how much you're paying in interest, $700 change in interest, then you add another 60, 70 bucks on top of that, you're almost saving, I would say $600 to $900, $800 overall, because more of it's going toward, a little bit more is going toward principal and a lot less is going toward interest. So that's the other thing you have to consider, is that the savings is actually quite a bit more. Now, what's cool about the VA Streamline IRRRL is it allows you to do this as long as we're meeting all the requirements. Also, how much you can save in interest is quite a bit. But the main thing we really want to ask when it comes to the VA Streamline IRRRL is that what are your intentions with this house over the next 3 years? Because yes, there's going to be costs. Your loan amount is going to go up a little bit based on the remaining balance. But does it make sense based on your 2 to 3 year timeline? If you intend on selling the house within the next 2 or 3 years, there's certain scenarios where the refinance may make sense, but in most cases, if you're going to sell the house within 2 years, I wouldn't even consider doing a VA refinance at all, unless it was to put you in a better position to sell the house. Because if it doesn't, you could be putting yourself in a position where you'd be paying closing costs on a refinance and closing costs on the sale, when selling or refinancing basically does the same thing. So for example, let's say you did a cash out refinance right today, knowing the house is going to be sold in like a year and a half. If you did a refinance today, you're going to have your closing costs, which impacts your equity, and then you're going to sell your house, which you'll have closing costs that impacts your equity. You might as well just wait to sell your house, get charged for closing costs one time for that specific house. That way your equity is not being eaten up unnecessarily. So that's one question I always ask to make sure if clients are making the right choice is, what are your plans in the next 3 years? Oh, I plan on being in the house in the next 5. Then depending on which option, that option will make better sense. We also, depending on the situation too, rates might also continue to get better. So some clients would consider, I would rather just wait till rates get lower. But the thing is, it's a forecast. So some of them rather just jump on it now, and if rates get better, they'll refinance again because they intend on being in the house for a long time. So if they're in the house long enough, then the 2 refinances they did will actually start making headway and start coming back to them after some time. So that's, again, something that is a very case-by-case scenario. Amortization gain has something to do with how fast you're paying down the mortgage based on that newer rate. So obviously, if you have a lower rate, this $60 change, actually over the course of 7 years, you're paying down your mortgage about $7,000 more in 7 years than you are right now. So, and that's assuming you don't add extra payments to your mortgage payment. So those are the types of refinance you can go into. As far as that goes, I mean, there's a lot of options when it comes to refinances, why you should do a refinance. It does take a discussion because it does take the equity of your home. So we got to make sure that it's the right choice for you based on your current plan. So a lot of people do get, after they buy a house, about 5-6 mortgage payments in, they're going to get a lot of mailing as far as other creditors trying to get them to do the refinance. So the reason why you're getting that mail is because a lot of times after you've closed on your house, you get on this list of people and a lot of people will buy this information and they'll put you on like a timer so that when you've hit your seventh mortgage payment, because a lot of them will know when your seventh mortgage payment is going to be based on closing date and when your first mortgage payment is. So about the 6th or 7th, you're gonna get all this mail, and they're gonna be like, oh, these are what rates are. You can have this much equity reserves or this cash reserves or equity cash reserves. They're really just trying to get you to do a cash out refinance so they can have more transactions on their books. They're really not looking out for you at all. That's what's really unfortunate. But they're going to make this letter look like it's from the VA or from your current mortgage lender. I've seen it. And the reason why you're getting that is that a lot of these people have bought your information and found ways to contact you as soon as you make that seasoning requirement of that 7 mortgage payments. Whether if it's actually good for you or not, that's not what they're concerned about. They're just trying to make it look sweet so you can talk to them and then move forward with it. So I've seen a lot of clients go this refinance, and sure, it works. It makes sense at the time, but it actually puts them in major detrimental problems later on. So that's what's the problem, is that they're trying to prey on your instant gratification of trying to get this refinance and get a better payment and all these equity reserves, when it actually does not serve you 2 years from now. So be very careful of those when that happens. So you're gonna get those mails a lot. It's just the way it is, because your information is being sold and people buy it, and honestly, it's not really hard to find either. So hopefully this gave you guys some insight as to what the refinance process is, what it looks like, why you should do it, why you shouldn't do it, as far as those numbers go, what the process and overall. So hopefully this helps. That's all I got for you guys today. Nuke out.